Good morning and welcome to the MCTA's third virtual presentation. I'm sure you'll find today's session interesting and informative, much like the others. And we're honored today to have an esteemed panel of experts with us to talk a little bit about OPEB. Before we begin, I'd like to introduce today's presenters, and then we can just dive right in. Our first presenter, Kristen Richards. Kristen is an associate director with the East Region of the Local Governments Group with the U.S. Public Finance. He analyzes credits primarily in New England and the Mid-Atlantic, serving as S&P Ratings local government portfolio lead in Rhode Island and Massachusetts. Prior to joining S&P, Kristen was a legislative analyst with the American Public Transportation Association, where he provided analysis and guidance on federal authorization, appropriations, and tax legislation, as well as administrative rulemaking. He also worked with transit-related businesses nationwide to understand how changes to federal law may affect them. Before joining APTA, Kristen was a congressional staff member in the Washington, D.C. office of Congressman James Lanivan of Rhode Island. Kristen graduated with a Master of Public Policy from American University in Washington, D.C. He also has a graduate certificate of public financial management from American University and a BA from the University of Vermont. Welcome, Kristen. Our next presenter after Kristen will be Chuck Patterson, known to many of you. Chuck is the Senior Vice President and Chief Operations Officer at Batholomew and Company. Chuck is responsible for ensuring that we meet all clients' fiduciary needs and assisting municipal clients with law interpretations and procedural policies as they relate to Mass General laws and Treasurer Office operations. Chuck's background includes a 14-year tenure as the Treasurer Collector for the town of Shrewsbury, where he was responsible for all the cash management functions. He implemented the town's current investment policy and managed the town's $90 million in annual general operating receipts. Chuck maintains numerous professional associations, including the MCTA and the Worcester County Treasurer Collectors Association. He is also a past president of both of those organizations. Welcome, Chuck.
Thanks, Renee.
Okay. Kathleen Glowacki, I think I said it right, Kathleen, is director of the Investment Management Department at Batholomew and Company. As a director, she oversees the department's investment analysis, portfolio management, and performance monitoring responsibilities. In addition, she prepares financial research, market commentary, and economic update materials for internal and client communications. She holds a bachelor's degree in economics from the College of Worcester and a master's degree in business administration from Babson College. Welcome, Kathleen.
Thank you.
Our final panelist today, Mr. Parker Elmore, President, CEO, and Actuary at Odyssey Advisors. Parker is dedicated to quality service, expertise, and efficiency. With over 30 years of industry experience, he develops and implements solutions to the complex financial issues faced by governmental and private sector employers. His personal philosophy is to listen and to customize solutions for your individual needs. Throughout his career, he's worked with qualified and non-qualified retirement plans, as well as OPEB plans, including the costing, funding, and design of employee benefits. These clients have ranged from 1 employee to over 100,000 employees. Parker is a frequent speaker at various professional events to share his expertise in retirement, OPEB, and other topics. Thank you, Parker, for joining us today. And lastly, before I sign off, I'd like to extend holiday wishes to all. Enjoy the season, be blessed, and stay safe.
Thank you.
Thank you. Okay. And I think that will lead us right to Kristen.
Thanks, Renee. All right, let me pull up my presentation here. Can you all see that? Okay. So this is not in any way meant to be comprehensive. So I just want to touch on a few things we're thinking about. If there's things I don't touch on or you want me to expand it, just ask, or if we don't get to it, just call me later. We're always here. So with that, I did want to start at the beginning. Is this, can you guys see this okay? Is it coming through? Okay. I think starting at the beginning, everything we do is guided by this underlying criteria. It's our local government's criteria. And then within that, there are these sub-factors that form this weighted score. And one of those is debt and contingent liabilities. And specifically within that, we talk about pension and OPEB. And then within that, we talk about, what is the size of the liability? What is the pay-go cost? What's the funded ratio? What are those assumptions? And that's part of this indicative rating that feeds into a scored criteria model and then pops out sort of what the indicative is. And we won't go through all of that. That's sort of the main area where we look at OPEB, but it's not exclusive. We have this, anyone who's on the line who's spoken to me knows we spend a lot of time going through what your financial management policies, your practices are, and we will look at pension and OPEB within that, particularly within, say, budgetary assumptions, where if we're pretty confident that your costs are going to continue escalating, or are you thinking about that as part of your long-term financial planning, your annual budgeting? And then the other one is budgetary performance, which is really, did you have a surplus in the most recent year? Are you projecting one? And what are the impacts of your OPEB costs on that? If you were paying the full ADC, what would that look like? And so we do make data adjustments based on a number of things. Sometimes it's recurring transfers. Sometimes we'll pull out your expenditure of bond proceeds. Sometimes we'll add into what we think your expenditure should have been if you're grossly underfunding. This really happens with pension, but what would the cost have looked like? What would your performance have looked like if you had paid the full ADC? So that is really how everything else we're going to touch on sort of feeds into the criteria and the modeling aspect of it. And then, as Parker mentioned, I think we're going to make available a number of publications we've put out that says, okay, here's how we're thinking about these other topics and how they feed into this criteria aspect. One of those is we put out this guidance piece. It's been updated. I think the most recent update is that October date. What does S&P view as a reasonable plan? Well, getting to 100% funded. I don't offhand know of anyone in Massachusetts, any town that has a 100% funded OPEB plan. I think that's something that we're talking about over a longer time horizon, but certainly these are things that we want to see. Okay, when you're thinking about your funding plan, how are you going to get to 100% funded? A discount rate, 6%. That more often comes up when we're talking about pensions. For OPEB, it seems that at Parker and a lot of actuaries are having discount rates well into the 4s, really close to that municipal bond rate. And so this doesn't come up as frequently unless there's a trust that's particularly well funded, that has some sort of assets that are material. You could start to see higher discount rates. And then within that, we look at your contribution progress. Are you making material progress in a reasonable timeline to address those liabilities? We think a reasonable timeline is this 20-year length or less. Closed amortization period. I think the big thing for OPEB though is this long-term medical cost trend, and we've sent this, I can't remember if we call it guideline or benchmark at 4.5%. Where I think Parker will probably talk on this a bit more, but what is a medical cost trend? It's just your year-over-year cost to your medical claims. If you're really under that 4.5%, we think you're probably understating your liabilities and potentially understating your costs or future costs. But yeah, I mean, that's the big thing that we're looking at as far as OPEB. And I'm actually going to skip slides here. why is that important? And let me zoom in here because this is not, let's see if I remember the shortcuts. Nope, that wasn't it. A lot of the publications we put out are on the state level because it's a lot easier to aggregate data for 50 states than it is for several thousand municipalities. And so what you have here is a chart showing the increase in medical costs versus the increase in per capita income. And so you're looking at the blue bars being the increase in healthcare expenditures and the yellow dot being the growth in per capita income. These red arrows, you see a large divergence. Yellow arrows, they're pretty close together. That sort of same concept exists in municipalities as well. As if you were in an area that is low growth in incomes, low growth in a tax base, that is not going to have anything to do with the growth in your medical expenditures. Those are going to go up, 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 and so you're going to see an increasing delta between the two. And we think that speaks to the affordability of your future costs. And again, a lot of this is pulled from one of our state publications, but the pace of medical expenditure growth is important. How are you thinking about that in your future costs? If you know those are going up, are these going to increasingly crowd out future expenditures, future budgetary expenditures? And so the other place that this ties into, I just want to go back here, is what is your OPEB? What are you offering? It varies by state. I do cover a wide range, and in some areas, you participate in your employees participate in the state plan, and those benefits are defined by state law or state statute or whatever the state plan is. In Massachusetts, it really is town by town, in my experience. And so, are you offering healthcare? Are you offering life insurance? What are your limits on that? You're all aware of the difference between explicit and implicit costs. I think a lot of our conversations with some towns, they say, "Oh, it's just an implicit, calculation." Well, we think that is going to come due. It's going to show up somewhere else on your sheet, but that's a cost that is going to be paid at some point, whether it's explicit or implicit. Who are you providing these benefits to? Is it retiree, and is it spouse? Is it just retiree? Again, here the dependents, they're often phased out, I think at 26, tend to be immaterial to the total liability, but other things that we're looking at. And I think the big thing is, you're offering lifetime, or are you bridging people to Medicare, or some combination thereof? And that, I think mostly in Massachusetts, and someone correct me if I'm wrong here, they tend to be lifetime. You get outside of New England, and at 65, you're cut off. And so, when we think about credit, and when we think about, what we're benchmarking against, it's not just Massachusetts to Massachusetts town neighbor. It's, okay, what's happening elsewhere in the municipal ratings universe that, okay, we're not just looking at Massachusetts, just not New England, we're looking at the US as a whole. And so how do those differences become apparent? We went through that one. I think this is the other really big thing we've been looking at is, what is your ability to adjust benefits? In Massachusetts, it tends to be the benefits are provided on a contractual negotiated basis. You see some minor adjustments through updated contracts with some cost shifting. You're going to a higher deductible plan, so you'll see savings in future years. In other states, you can't cut benefits at all. We think in Massachusetts, generally you have that ability, but you're probably not just cutting retirees' benefits. I don't think with some of the strength in some of the labor unions here, it's just probably not happening. And so there's this environment. There's what are the legal, practical, and operational. This happens less in Massachusetts too, but I've talked to a number of towns where they said, "Oh yeah, we cut all these benefits and then we couldn't hire and retain anybody." And so, what does that look like if you're adjusting benefits? Are you able to hire? Are you able to retain? Or are you able to hire at an entry level and then they go somewhere else for the next 30 years? I mean, what does that look like? What are the financial impacts? Maybe making all those adjustments has a minimal impact. And then what are the political impacts? So I'm not going to read this whole slide. I do apologize for all the words on here. I see we've gone to our first poll question here. So it will give people time to answer that, and then we can circle back around to that. The other thing that has come up increasingly in conversations is these OPEB obligation bonds, similar to POBs. You're taking out debt to finance your OPEB obligation. The answer to it, is this a good idea or not, is one for your actuary and your financial team. The credit impact varies, though. It can work out well, it can work out poorly. A lot of it depends on timing. I think we've got a couple of issues here. I think this Minnesota one really pops, where these 93 districts issued 700 million in OOBs, and then the subprime mortgage collapse happened, and they were on the hook for the debt, and then their investments went south, and they had higher cost than they would have otherwise.
Parker here. Can I just pop in for a question on that OPEB
Yeah.
obligation bond? Because that was actually on my list of things to ask at the end about this, was about, because as a mathematical exercise, I tell clients all the time, OPEB obligation or pension obligation bonds, when they would make sense is when you guys will never, ever do them. In March was a great time for an OPEB obligation bond. Nobody was doing them. 2008, 2009, markets at a low, interest rates are at a low, nobody's going to do them. Now that the market's at 30,000, now I get questions about should we do one? So again, talk a little bit on the credit agency part of it, because a math exercise, I say it's almost always a bad idea, but I'm curious on the credit side.
Yeah. So again, a lot of times I have dealt with maybe one of these. It's not something that happens that frequently. I think the number that got thrown out is that 50% of the time it works out, and 50% of the time you would have been better doing nothing. I don't know if that's exactly true, but I think the sentiment is that, if you mistime the market, you could have issues. From a credit perspective, it's not always immediately apparent what the credit impact is going to be. And so we may write up a report saying, here's what has happened, here are the risks that we've identified, and we'll have to see over some longer time horizon how that affects. And if I go back up to this first slide, what are the effects of that OOB on budgetary performance, your future ability to take out debt, or you over leveraged and you can't fit those, either that you've hit a statutory debt limit, or the increase in the carrying charge would be too significant to incorporate into your budget. And so I think that generally we would say, here are the risks, we're going to see how this plays out. It may be good, it may be bad. And so it may be, you would be to issue an OOB, we affirm your rating, stable outlook, whatever, and then in 3 years it's gone sideways, and then you're downgraded, or it works out great and we upgrade. Like there's just so much unknown that often I think when we have rated these, that we've written a very long couple of paragraphs saying we're going to continue to monitor this. And same thing, I think these Minnesota school districts issued in 2004, and then it was a number of years before they ran into trouble. Like you just don't know. Could be credit positive, could be credit negative. I think it's definitely going to be a negative from the onset, though, is if you have some sort of need for structural financial relief. And so if you're issuing this saying, this is the only way I can make my ends meet, well, that's not going to be a credit.
Well, if you're Illinois, or if you're some of these other states.
Yeah. And again, we touched on these other ones. I think the other thing, though, is this middle one, where if you were taking this out but not making any changes to your structural benefits, that's also likely probably a credit negative.
Yeah.
So that is all of the slides I put together. I just want to touch on basically the structure of what we're looking at, and a couple of these things that maybe have not come up in your conversations with S&P, but that we're thinking about sort of in the background when we say, we think you have a credible plan. We don't think you have a credible plan to address these obligations.
I'd like to, first of all, thank Renee, the MCTA, the Executive Board, and the Education Committee for pulling this thing together. Originally, this was going to be a presentation that we were going to make in April, pre-COVID. And at that point in time, we were going to have a representative from the Division of Local Services doing my portion. But right now they have been working on, as you know, what's new in municipal law. So they are not here today. So I will go through the informational guideline release. Next slide, Kathleen. 1910, and I'm not a lawyer. And these are just my outline of what the IGR said. So if you have specific questions regarding the IGR, hopefully I can touch upon some of the key highlights of it. Certainly we all waited a long time for this. Hopefully we get all of our questions answered here. So what does OPEB do in the IGR? It establishes an OPEB trust fund, and it also sets out trustees and declaration of trust. Prior to modernization, there was no declaration of trust that was in existence in our guidelines. Okay, it requires that we have money set aside for current and future liabilities of the governmental unit. It establishes procedures to set up that adoption of trust. Okay, in the pre-modernization, it didn't address school districts or any other municipal entity other than a city or town. So they were able to get that into the new legislation. And it also, in the new legislation, allowed you to participate in another governmental entity, OPEB Fund. Next slide, please. So then what it says here, in November 16th, that was the modernization law that went into effect. You can do one of two things. You can re-accept it, and then you'll end up following all the new guidelines of the law. So post-modernization. If you choose not to do anything, you follow all the guidelines set forth in the original law. Either way, you still have to do your actual report as set out, and Parker can talk about the frequency of that. And as we all know, that the law cannot be revoked. So once you use it and adopt it, it is in existence until the funds are no longer needed. So meaning that the entity ceases to exist. Well, I don't believe in, hopefully none of our cities and towns will cease to exist. And then it does say that the town clerk or city clerk or the clerk of the unit should report to the Division of Local Services. Next slide, please. Okay, purpose of the fund is there for the benefit of the employees and their dependents. So the retirees and their dependents. So you can use the money to pay for retiree health insurance benefits. Okay, and certainly there to ultimately grow and to eliminate the unfunded liability. Next slide. In the new piece of legislation, it talks about setting up a trustee and a board of trustees. In the prior pre-modernization, it did not address that. On the books of the town, we must set it up as a separate account, and it must be segregated out to protect the fund from any creditors of the entity. And in the law, it does state that the treasurer of the governmental unit shall be the custodian of the fund, and he or she must be bonded. Right? Okay, who is the legislative body of these units? Certainly as city or town, it's a legislative body. It's county commissioner in the county. In a regional school district, it's school committee. And if you are another form of district, water, sewer, fire district, it is the appropriating body or the district meeting. Next slide. Okay, certainly you'll find when you're reading the legislation and in the IGR, it talks about pretty much who's in charge. So it's a chief executive officer, so it'd be the mayor or the board of selectmen in cities and towns. Once again, county commissioners, once again, school committee, and the governing body. Yeah, in the districts. Okay. The treasurer in these units shall be the trustee of the trust, unless the governmental unit sets something else out. So the treasurer by default is the trustee. Or you could have your local retirement board as the trustees, or you could set up an independent board of trustees. To our knowledge, we don't know if there's been any entity right now here in the Commonwealth to take this third. Next slide. Next slide, please. What that means is the board of trustees, if you don't have your treasurer, it will become a board of 5 to 13 members. And the key thing here is you have to have one person with an investment experience, one citizen, one or more retiree, or one or more officers of the governmental entity. Next slide. This is probably one of the main reasons why cities and towns have not selected to go down this route, is because the employee and the retiree must be elected by a ballot. So you would have to have an employee who chose to be on the OPEB Board of Trustees, and you'd have to have an election. Retirees are a little bit easier because in a lot of cases there is some form of an election, but it would be managing the process of electing an employee to the OPEB Board of Trustees. And then the chief executive officer, as we talked about earlier, will then appoint the rest. And then they all will be serving 3 or 5 year terms. All our treasurers have always acted in a fiduciary manner. You know, you're always acting in the best interests of your communities. But here the law clearly states it. You must act as a fiduciary with primary purpose of enhancing the value of the fund. And that really comes into play with what Kathleen will be talking about later on how much risk are you going to be taking in managing these. You're going to act with care, skill, prudence, and diligence under the circumstances that a prudent person acting in the same capacity. So all that means is if you are working with these funds and you're taking actions, if another person that acting prudently would act in the same way, then you would be covered. You have to diversify the investment of funds to minimize risk or large losses, unless circumstances it is clearly prudent not to do so. So that's a whole discussion about risk. Okay, trustees as an investment authority. You may employ investment consultants, and any other duties must be stated in that declaration of trust. So this is really this other document. You've talked about an investment policy, but now there's this other document called the Declaration of Trust, and it spells out a lot of the duties that the trustees will have, the investment people will have, and so on and so forth. And your trustee may be indemnified. Okay, the Declaration of Trust. Okay, you must adopt this. And must be filed with the chief executive officer and the clerk. Okay, and the Declaration of Trust will go into play after 90 days, and you have to publicly post it. So this is very similar to a regular private trust, where you're sitting there and saying, here's my trust, And certainly on private trust, you're not showing them, but in this case here, where we are public, you're letting the public know that there is an OPEB trust that now exists in your community. Okay, how do the money gets into your funds? We all know that we can appropriate it. I still haven't figured out why would somebody give a gift to the town to fund our OPEB liabilities, but we could do it. Certainly the fund would receive all the income and the growth of it. And as you recall, initially Medicare Part D funds went into it. That's how the money gets in. Next slide. Okay, your treasurer may employ outside custodial services, so he or she can get help there. They may invest in the state retirement benefits trust fund. So, Brett. Okay, treasurer may. This is a very, very key point. We're going to show at the end of my presentation the different motions and articles that you're going to need. Currently, the way 32B20 post-modernization was written, it comes into, and you're going to invest under Chapter 4454, which is the legal list. So, as we talked about being prudent, you're going to need a second vote by the governing body to allow you, the treasurers, to invest as a prudent investor, which is 203C. So what we have seen in a couple of instances, cities and towns had to go back and make a secondary vote to get this thing accomplished. Okay, in the initial law, pre-modernization, there was never any mechanism to spend money out of the fund, but now in post-modernization it does, and it needs a 2/3 vote of the governing body. So now there's an actual mechanism to take funds. And certainly if you're a regional school district, you have to make sure that you need to get this into the budgetary process so that all your cities and towns will be aware of this approach. Next. Accounting. The accounting officer must set up a separate fund, which we all know that. As Parker will talk about, we need the actuarial studies. And then in whether, as I said on one of my first slides, you still have to, regardless of whether you voted this in pre-modernization or modernization, you still have to report back over to BERA. And then in the regional school district, the districts should tell all of your member towns how much is in the fund and what's going on with the fund. Next slide, please. Okay. As I said earlier, you may participate in another pool type OPEB fund, and a majority vote of the governing bodies have to allow that. You must keep all the costs associated separately. So in other words, A town won't be responsible for B town's healthcare costs. And you may send money in each town separately. You're not tied together. So if one town wanted to, fully fund and another town didn't, that's totally fine. And there must be a separate accounting. And then my last slide will be, and very, very important to each of you, if you have gone through and voted initially under pre-modernization, here's your readoption votes. So as you can see, they are all articulated out very, very nicely in the IGR. The articles are there and so on the motions. So I would refer you to the IGR If you have questions there, I would then go to your local town council. So I believe that's ending it up from my presentation. So as Renee stated, I wish everybody a healthy holiday season and hopefully a better 2021 than what we have all experienced here. So have a nice day.
Agreed. Thanks, Chuck. So I'm going to talk a little bit about investing OPEB now. So a couple of points about setting up the long-term OPEB assets, and then some continuing due diligence, things to think about as far as risk profile, like Chuck said, and then some additional tidbits or ways to kind of benefit your OPEB that you can think about moving forward. So for setting up, Chuck touched on this first point, which is understanding the part of the law that is about the Board of Trustees, which is, you know, as you saw, by ballot and by all of the requirements, can be burdensome. So what type of support do you have? What are you comfortable with? And, you know, especially going forward as these funds continue to grow, to remove some of the burden from the treasurer to at least have some type of advisory board is a good idea for that setup and to continue to think about. Secondly, ensuring that these dollars in the OPEB fund are in fact long-term. What we don't want to see is, you know, someone calling us and saying, I need to tap into my OPEB to pay this fiscal year's healthcare premiums, right? That can be a challenge from an investing perspective because, and for plenty of perspectives as well, I'm sure Chuck and Christian can comment on that as well, but this is for long-term money. This is 20 or 30 years before you're drawing from it, which is a very different investment philosophy than investing something just for like 3 months. So when these are, you know, this money from our perspective, of course, needs to be that long-term money. And then determining a risk profile based on a bunch of different aspects here. Of course, your discount rate, unfunded liability, your contribution rate expectations, and your community's risk tolerance. So to that point, you know, here we have our efficient frontier, and all this is showing you is as you increase the level of risk in your portfolio, now it's not linear, but the more risk you take on, the more return over the long term. And so you'll see on the bottom left, that's a fairly conservative portfolio, 30% stocks, 30% stocks and 70% bonds. And then as you go up there, you're adding more and more equity. And really the question we get a lot is, you know, where do our clients' OPEB portfolios lie? We manage about over 160 OPEBs at this point. So I would say most of them are in that kind of in the middle, going to the higher end of the more aggressive side, which makes sense logically, right? This is 30-year money. This is, and then it's perpetual, even beyond when you begin to draw on it, it's perpetual, right? So from a logical standpoint, you want this money to grow. We sometimes joke or give some context about it's like a 20-year-old investing for retirement, right? Except this is even more extreme because, as I said, it's perpetual. And one of the good things about you know, a scale like this and utilizing an investment manager that can keep your portfolio separate is because a lot of this can be political, right? Or if you are a treasurer in a city or town, you might be used to more conservative funds. And so sometimes we have a conversation where people say, okay, we understand we have this really high unfunded liability. We know we should be more aggressive, but we want to start somewhere a little more easy to swallow. And then as education and communication continues, you know, we've seen people move up the risk scale. So kind of from our perspective, you should be taking on, you know, a decent amount of risk. But we've seen everything across the board. We have OPEBs in all of these asset category breakdowns. But the bottom line, you know, of course, Parker has talked about this, your actuaries talked about this, is that every asset class is tied to a different rate of return, right? So the higher, you know, the riskier assets have a higher rate of return, which benefits your actuarial study, right? So that's a key point to, you know, keep in mind here. And then another thing, kind of on this tune of continuing due diligence, you have that high level broad risk parameters, but then you have a lot of other components, because prudent OPEB, you really, the world is your oyster from our perspective as far as investments. So what are you expecting? What is your investment manager doing? Are they trying to replicate when you know, turn on CNBC and you see the Dow Jones or the S&P 500? Are they trying to replicate that? Is that what your community wants? Are you investing in experts who are, you know, managing certain asset classes based on their professional expertise? Does your community really care about value-based investing? Environmental, social governance, ESG is kind of the term now, which has changed a lot. We've seen a lot of continuing interest in that. And particularly as your funds grow, should you have more involved management and analysis of individual stocks and bonds? And so these things I think are important, particularly as the funds grow, particularly as there's more and more committee involvement and things like that, just to be aware of, to make sure you understand what your options are, because there are a lot. And then, you know, kind of just having this framework and this foundation that leads to those underlying exposures. And, you know, that's the kind of the nitty gritty of investing. It's what percentage is domestic, what's international, small companies, large companies, things like that. And that all comes together in your investment policy statement, which we are pretty obsessed with the investment policy statement. So that, you know, we give drafts to our clients, and you know, you can have it be whatever you want it to be, really. But we think, as far as continuing due diligence, reevaluating those high level risk levels to make sure it makes sense with your actuarial report and kind of where you're going with that, and assessing those allocations and those exposures, the changing environment, whatever, you know, is going on, look at that at least annually. And then adopting, of course, a formal trust agreement to keep the OPEB funds for what they are intended for, right? And then I wanted to spend a little bit of time talking about a funding schedule. So this is twofold. Where is your money coming from? And I think I saw a poll question from Parker about this. So, you know, are there dedicated funding sources, and what are they? Of course. But for the sake of time, I just wanted to talk about when during the fiscal year those funds should be deposited into the trust. And sometimes we'll have people in March, let's say, oh, I have my OPEB I want to send you, but we're in a pandemic and the market is crazy and I'm afraid to send that right now. Or you see, as Parker said earlier, markets hitting all-time highs, and sometimes people are concerned about sending their contribution at that time. So I think something we've been talking about more and more is about dollar cost averaging. And this is just a very simple example. I wanted to have some kind of visual for you. So really what dollar cost averaging is just splitting up your contributions over a period of time. So again, simple example, you want to buy a stock. Right now it's costs $75 a share. You can buy all of the shares you want right now, or you can break them up over this time period where you'll be spending less money for them in the future and then more money for them. And so this applies to the funding schedule because we tend to recommend, if you can, to even have a formal process of saying, you know, on a quarterly basis, we're going to contribute this amount every quarter into our OPEB. And so that does two things, right? It helps neutralize some of that decision making that's stressful. I mean, this is what I do, and I wouldn't want to have to make a market timing call like that. So it neutralizes the decision making, and it also, as you can see from this very simple visual, it can mitigate some of the risk over time, over even, of course, a more extended period of time than this. And you know, it also gives your investment manager the opportunity to kind of navigate the crazy amount of opportunities we have in the investment world. So this next slide, some people hate this, this next slide, but bear with me for this because I do think it's interesting. Hopefully you can see that. If not, I know you have the slides, but the point here is this is showing you calendar year by calendar year in those columns. And then you have the best performing categories on the top to the worst performing on the bottom. And so you can see in every one of these categories, something we invest in. But for these types of funds, because they're long-term, we believe in a diversified investment focus. And over time, I know the colors are jarring, but the environment changes quickly. And these types of funds can take advantage of market changes and economic cycles, and us being able to essentially rebalance your portfolio on a consistent basis by going in where we're making the strategic changes, or we're saying, okay, in 2018 emerging markets, for example, was the worst performer. Is there an opportunity there for us? We're doing all of that on our side, but having that consistent dollar cost averaging can be beneficial. I could talk, if anyone is interested in this chart and you want to go into more detail, let me know. I love this stuff, but I know it can be a little bit blinding. And then the final thing I'll say, I think this is definitely something we've been talking about a lot, because your OPEB assets they're not pensions, but they behave, or their purpose is similar, right? They're both unfunded liabilities. They're both perpetual. So even if your OPEB is small, at least for now, you can still explore institutional asset classes because you are an institution, your communities are. So you can utilize things like private equity and real estate if appropriate. And on the left-hand side, this is sort of timely, but these investments are strategic. Of course, we don't market time or tell you should do this now for any particular reason other than we think it's a good long-term decision. So if you are, if you manage any cash or anything like that, you know that a lot has changed in interest rates over the past year. So I just wanted to show kind of a comparison from last year's interest rate environment to now. So a 3-month treasury, for example, at the end of October in 2019, you were getting paid 1.5%, and now you're getting paid essentially nothing, 9 basis points or 0.09%. And so a lot of your traditional bonds, of course, are tied to this. And this will, what the Fed does, how interest rates change in general for any reason, a lot of your bonds are tied to this, but quality real estate can be a good diversifier for that portion of your portfolio. Just like private equity on the equity side, I included this chart. This isn't the reason to invest in private equity, but I've mentioned this before, and people, I think, are sometimes surprised that publicly listed companies have gone down since really the .com era. Which is just kind of an interesting tidbit that we have less and less companies that you can buy, on an exchange traded, which means there are so many opportunities in the private company world. So we've found a lot of value in those, and our clients that have utilized those have been benefited by that in performance, but also before I turn it over to Parker, I'll steal probably something he's going to say or he has said, but something like private equity has a higher rate of return that he attributes to his actuarial report than public equity. So that benefits you in your discount rate and your unfunded liability as well. So that's a great benefit. And with that, that's it for me. So I'll give this to you, Parker.
Well, thank you, Kathleen and Chuck and Christian. Appreciate everything you guys have shared. And hopefully now you get to the actuarial portion. You're going, what happened to us? Why do we have to do actuarial stuff? but I'll do my best to make it as useful as possible. Let's do it that way. So again, I appreciate everyone's time here. I'm going to hopefully share the right screen. I thank you everybody for joining in. Here's what we're talking about OPEB in 2020, what I'm calling municipal jeopardy. How can we reduce costs and liabilities? So with that, let's get going here. I'll give you the quick 30-second overview of our firms. You know who we are. So we've been around since 1998 doing actuarial and management consulting work. Provide services to about 500 municipalities across the US, including about 300 in Massachusetts, offices in Connecticut, Nevada, clients in 37 states, Europe, South America, Australia. So I spend a lot of time on planes, probably once a week. In pandemic times, a little more challenging, but still try and get out there and see clients and people like that. All right, enough of that. So we come to municipal jeopardy. Look, they've cleaned out the board. All they've left us with is compliance. Such fun. So I'll take 1,000 for compliance, Alex. The task I dread doing every 2 years. What is OPEB? So our little tribute to Alex Trebek, who recently left us, is complete. So let's get on to why we're here today. So I'm not going to bore you to tears with all the stuff you guys have heard me talk about over the years. I know most of you are Odyssey clients who are here today. Thank you very much for that. For those of you who aren't, thank you again. I mean, taking the time to do actuarial stuff, I give you credit for that. So whether you're an Odyssey client or not, we're here to help however we can. So what is total OPEB liability? It's just basically the value of the benefits earned to date by both active and retired employees. For the active employees, it's a pro rata share of what they've earned to date by their service versus what the service they will have at retirement date. For the retired members, they've earned all the service they're going to have. So their liability is exactly what it is, the present value of all the future benefits. So we're going to do that. So how do we calculate it? Well, what's the discount rate? Those of you who've heard me speak before know that I have a bit of a problem the way that GASB decides to calculate discount rates, because I don't think they should be based on how you invest your money or the like, but these are the rules we have to deal with. So higher discount rates will get you lower liabilities and vice versa. So when we're calculating a future payment from 10 years, 20 years, 50 years out, we have to bring it back to today. The interest rate or the discount rate is how we do that. So how do we come up with the discount rate? It's not some actuarial mumbo jumbo, wizard and put everything in a pot and stir it around. Rather, there's really 5 key factors. So what are your OPEB assets? How much do you have in the trust today? What's the municipal bond index rate? What's your projected payments? How are you doing? You got 20,000 a year of payments, or 100,000 a year of payments, or $1 million a year of payments. How are you going to invest the money? Here's the thing. If you put all your money in T-bills, I don't care how much money you have in the trust, your discount rate's still going to be low. My problem with the GASB math is that if you put all of your investments, say, in Tesla stock or emerging market debt or private equity, you would get a higher discount rate. However, I would argue that just because you get a higher discount rate does not mean it's prudent or the right thing to do. So, the means do not, the ends do not justify the means, I guess, being my point. And then the funding policy, probably the most critical of these elements. How much money are you going to set aside every year? If you say, well, we throw in 20 grand, 50 grand, $1 million whenever we have it, that's great, but it's really a discipline. Pour the money in every quarter, every year, whatever it may be. That's really what you got to do. Then the question everybody asks, well, how am I doing versus my peers? Well, what you're going to see here is that you're going to see 77% of your people are less than 10% funded. 86% of people are less than 20% funded. So basically, you have a lot of company in being less funded than you would like to be. So, all right, enough of the assumption stuff, because again, ultimately, we can play with assumptions all day long and make your liability whatever we want. But that doesn't change your real cost. So how do we change real costs? Well, here's the thing. In Massachusetts, you are limited in terms of what you can do versus what we do in other states. So changing the eligibility to receive benefits. In Massachusetts, that's state law under Mass General Law. So you can't do anything about that. In other states, we might change it to age 62 and 25 years of service. We might change it, maybe eliminate benefits for spouses or children or people hired before certain dates. Can't do that here. We have to limit the share of retiree premiums. We can't go beyond 50% of the premium. In other states, including, say, Connecticut, it's very common to have 100% of premiums paid by retirees. New Hampshire, places like that. Section 18, hopefully most of you have done this by now, but basically what that says is Medicare eligible retirees have to move to Medicare supplement plans. Hopefully you've done that, as I mentioned. The prescription drug formulary and the benefits under Medicare supplement plans. we'll just give you an example. If you're using Blue Cross, for example, if you're still in MedX 3 for your Medicare supplement plan, you could go to MedX 2 and have significant easy savings. Now, again, it's a change in benefits. It's a reduction, let's be honest. But it's only going to affect probably 8 to 10% of your population. And yes, they're not going to be happy that some drug that they've used and they like is going to be no longer on the formulary or at a very reduced cost sharing by you as the employer. However, it will save you significant money. We find it'll generally save your OPEB liability by about 20%. So if you make that change, significant savings are there to be had. Now we'll talk about really the two main things I want to talk about today. Look for any retirees who are over 65 and remain in the active plans. So you've got Jimmy or Mary, who was a teacher back in the early 1980s, hung around for a long time. They left. They never paid into Medicare. There are things you can do to basically buy them into Medicare coverage, which will significantly reduce your costs potentially. Also, Medicare Advantage plans, not real common in Massachusetts. We see them in other places around the country. They may make sense for you, but you just have to understand what they are. So let's just boil down the lovely actuarial stuff to just a one-person plan. I know you guys all have 100 employees, 50 employees, 10,000 employees, whatever it may be. And it sounds like I don't understand how any of this stuff gets calculated. So let's just boil it down. We have one 65-year-old retiree, no spouse. He or she, we have an $800 a month HMO premium, $400 a month Medicare supplement plan. We're going to assume a 5% discount rate for this calculation. Our healthcare trend, for those of you who've worked with me for a long time know, we came down to 4.5% about a year ago. I acknowledge it took me a long time to come down there as a firm. We've struggled with that. I know we were higher than that for a long time. I know there are some firms that are down there in the 3.5% range. I have a tough time justifying that. I know Standard & Poor's, when we talk to them, they have a problem with anything below 4.5, and I tend to agree. And again, we're using 25% premiums here for the retiree cost sharing. So when we do that, you'll see here that I'm not going to bore you with all the math, but if you want to look at the presentation, feel free. But in this case, the retiree does not have Medicare. They were one of those older teachers that I mentioned, never enrolled in Medicare, never paid in the premiums. So you're saying, well, gee, we only charge $800 a month. That's a $9,600 HMO premium for the year. The problem is because of their age, their claims are really about $18,000 a year because that HMO premium is actives and retirees combined to create that premium. This is the place when you hear your actuary talk about implicit cost because the premium that you're charging them is $9,600, but their actual cost is more like $18,000 and change, which means that you as the employer have about a $16,000 liability for that 1 year. We discount that all back to today. That's about a $475,000 liability for that one retiree. Now let's take that same retiree and say they're in Medicare. Under this scenario, their premium drops to $4,800. Their premiums, because again, it's all the age 65 plus people are combined, their actual costs are only about $3,500 and change. Over time, their total liability is about $76,000. So as you'll see on the next slide, without Medicare, we're at $473,000. With Medicare, we're at $76,000. So again, Medicare wants to pay about 80% of the bill, and you're saying, no, we're good, we'll pay it. Here's the thing. You can go to CMS and negotiate with them to buy Medicare Part A premium for these people. I'll talk about this in the next slide. How these people, you say, well, come on, everybody's eligible for Medicare. How are they not eligible? Well, as I mentioned, if they were employed prior to 1986 and they've stayed in employment and they're in a public retirement system, they may never have paid into Medicare. So in that situation, you can buy into Medicare. You go to CMS and you say, listen, I want to buy Medicare Part A for Jimmy or Mary. And you want to do that. Now, under Mass General Law, you have to pay for that. You can't make the retiree pay for that. But you will pay the Medicare Part A, you'll pay the Part A and Part B penalties, and then the retiree can then purchase Part B just like all the rest of your retirees. They can also then purchase the Medicare supplement plan. Then you go, yeah, but this Part A, it's $400 and change a month maybe. The penalties might even be $100, $200 a month. I'm going to pay $600 a month. That's $7,200 a year. It's cheaper to just pay the HMO. The HMO is only an extra, $4,800 a year beyond the Medicare supplement under this example. But here's the thing. That's only because you're not counting the implicit cost. When you factor that in, your cash savings in terms of the actual reductions you're going to get are probably in the neighborhood of about $12,000 a year, even after all the penalties. So if you're self-insured, this is a layup. If you're not self-insured, you need to talk to your healthcare consultant because the way that this works is that basically what's going to happen, we're going to go purchase, we're going to identify all the people, see who they are, review if they have any partial credits. Maybe they worked part-time jobs. Maybe they, somewhere along the lines, they picked up credits. For the people in the GIC plans, if you're in a GIC plan, this is not going to work for you. Your retired teachers in a GIC, this is not going to work. But you talk to your healthcare consultant, you identify these people. And again, the reason why you do this is because in theory, we're taking all of these retirees out of the active retiree pool. When we do that, your active premium should come down. If it's not going to come down, don't do this. But again, talk to your healthcare consultant. We've been seeing for people that are doing it, their healthcare premium for the actives generally drops by about 2%. This slide is something that comes out of our report. If you're an Odyssey client, you've seen this slide before. We just identify, you have, in this case, this client has 78 retirees and spouses over the age of 65 who are still in active plans. For those 78 people, it's about a $44 million liability. Had those people been in Medicare, it'd be closer to a $5 million liability. So they have a potential $39 million in savings before the penalties. So after penalties, we factor those in, maybe it's about $30 million, once we find out what those penalties are. For most of us, that's real money. Again, every organization is different. Again, why you need to talk to your healthcare consultant. But if your actuary doesn't provide you this kind of information, I suggest you ask. It's the kind of thing you're going to need or want when you talk to your healthcare consultant. All right, so enough of that. Now let's talk Medicare Advantage plans. You're saying, I've heard about these things. I see all the ads from Humana on TV all the time. They're on all the time. So a Medicare Advantage plan, also known as an EGWIP, these are group plans. These are things that you as the employer can offer. A lot of private companies offer them. Unions may offer them to their employees or groups. They generally offer more benefits than traditional Medicare. But here's the thing. They're generally a PPO. So in other words, they have a limited network. Medicare allows you to go to any doctor you want effectively. The PPO says if you go to doctors in the network, you get a better price than if you go to doctors outside of the network. So we've had a couple of our clients in Massachusetts be offered these Medicare Advantage plans, and they look extremely attractive. Oh, the premiums are so much less. We should just do this. And I'm not saying you shouldn't. It's perfectly fine so long as you understand what you're buying. So the idea here is you have a limited network. For those of you old enough to remember the early 90s when HMOs started to become a much bigger thing, we ran into the same issue here. We go, oh, we'll go to HMOs. We can save all this money. And they go, well, how come my doctor is not covered? The reason we get the savings is we selected doctors who will give us better pricing. They do that in exchange for volume. So the same thing here with the EGWIP. So here's the thing. In an EGWIP or a Medicare Advantage plan, they have to offer all the same services as Medicare. It's not like they can pick and choose. They can offer more than that, but they cannot offer less than that. The idea, what happens here is they go to Medicare and say, listen, we're going to take these retirees off your books of Medicare. You guys will write us a check and we will take care of these retirees. So they are off traditional Medicare and they come over to the EGWIP. So it still covers Part A, which is all your hospital insurance, your Part B, which is the doctor visits. They'll have the Part D, which is prescription drug. They might offer other things like dental, eye exams, podiatry, things like that. And sometimes they may even offer things for your dependents of retirees. So again, they're not obligated to. Each EGWIP is different. So you got to look at these things. Again, they may make sense for you. We see them very commonly. I just did a big plan in Michigan last year. We put in this and basically moved all the retirees to the EGWIP and they saved a lot of money. I've seen it in corporate America many times over the years. So it can definitely work. But again, you have to understand what you're buying. With that, we have questions available if you guys want. Here's my contact information. You're welcome to reach out at any time. I know, again, most of you are already Odyssey clients. You know how to do that. But even if you're not, you just want somebody to come out and talk to your group, explain one of these things, that's fine. We're happy to do it. So at any time, reach out and we're here to help. Thank you again for the time. And if we can do more, just ask. Thank you. So that's pretty much all I got. I don't know if Christian, Chuck, Kathleen, any guys you want to chime in with any questions, comments, concerns? Hey, Barbara here is asking why a town would do an OPEB obligation bond. And I guess, Christian, do you want to talk about that quickly? I mean, I'll certainly chime in as well, but if anybody else or Kathleen or anybody wants to talk about OPEB obligation bonds and why a town would do that?
Just an ability to go out and pre-fund the obligation and sort of, that's sort of the base. part you've dealt with more than I have. I mean, maybe from your perspective, what are towns seeing there?
Well, I mean, those of you who heard me speak about it before, I always tell you, pretty much for the most part, OPEB obligation bonds are sold, not bought. And so generally my argument is that it's an arbitrage thing. You have an investment person who comes in and tells you, you can borrow money at 2.5%, 3%, and we can invest it out here at 7%. Because of all that incremental savings, it reduces your cost over time. But the point I always make to you guys when I talk to you is, are they guaranteeing you the 7%? And of course, the answer is no. And as Christian's slide showed, you can easily have a market downturn right after you agreed to commit to 30 years at 3% with no guarantee of getting that 7 or 3 or 5 or whatever it's going to be. So they can work out, but there's no guarantees. And, again, it's your call. But as I said earlier, I mean, my thing is the time when they make the most sense is when interest rates are very low and when the market is very low. Unfortunately, what happens is when we get to Dow 30,000, now everybody says, "No, we should really do something about this. The market's going crazy." Guys, you can take your entire portfolio and put it in Tesla stock too. And if you've done that 5 years ago, you're a hero. For next week, I have no idea. So that's not really what I'd call, to Chuck's comment about prudent investing. If it works out for you, great, but that doesn't mean it was prudent. So that's all I got on that, Kathleen. I don't know if you have anything, or Chuck.
I like that line. If it works out, that's great, but doesn't mean it was prudent. And that's.
Yeah, no, sadly, that is the
great.
case. I only know that well because I have a client of mine who put their entire retirement account in Tesla stock, and it did phenomenally well. Unfortunately, because of qualified plan limits, we can't pay him out the money. So he has $2.5 million in an account that I can only pay him $800,000. So the IRS is going to give about 90% of the balance. So he, despite the fact we told him not to do it, he did it anyway. And now we have difficult conversations. So such is life. So, but anyway, well, I mean, that's all I have on my side. I mean, I very much appreciate everybody taking the time today, and wishing everybody very happy holidays. And again, I encourage all of you guys to look at the great resources back in the chat that Christian provided. What we will do is when we send out an email afterwards, we will include all those links to everybody so you guys can all see that. And so if you didn't have a chance to download them, we'll make sure they're available to everybody. And again, if you need anything, I'm sure I speak for everybody here, reach out to any of us, Chuck, Kathleen, Christian, myself. We're all here to help. So if we got things we can do, to certainly reach out. We'll do whatever we can. Renee, I'll turn it over to you.
Again, I just want to thank everyone for participating today. Thank you to all of the panelists. This is all very, very interesting and very timely and informative. And again, I just want to wish everyone a very happy holiday. Be safe, enjoy. And thank you.
Thank you.
Thank you.
Thank you.
Everybody.
Bye, guys.